Good afternoon. The Fed sure shook up the markets here this week. Shouldn't be much of a surprise, but certainly has been. So excited to dig into that. We're really going to spend all time Fed this week. Unfortunately, fortunately, it just is what it is. So we're going to spend a lot of time talking about the Fed meeting yesterday and what that means. My name is Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, data, the stuff we're watching, and hopefully weed out a lot of the noise that we're seeing along the way. Hopefully everybody had a good week going into this, a good weekend. I'm back from Vegas and walked into this storm. I was out for a trip last week, so jumped right back into things, that's for sure, with the markets here this week and all the Fed hype. So I'll touch briefly on the housing data that came out this week, but we're going to spend all our time on the Fed. Housing data came out actually just slightly higher than expectations. But again, at the end of the day, the Fed is all that really matters this week. Like, let's face it. So we're going to spend our entire conversation today around the Fed decision and what may be ahead. Plus, we have a great question of the week from Amy. So thanks so much for sending that in. Basically asking, is the Fed prioritizing lower inflation or jobs? And I'm going to spend a lot of time touching on that too. So Fed meeting decision and press conference came out yesterday. I don't think it was much of a surprise. The Fed raised rates 75 basis points to 3 to 3.25. But I think where maybe the market was taken by surprise was what they had shared about what they expect moving forward. So they said basically by the end of the year, we're looking at a 4.4% rate. The reason that's important is that I think the market up to this point was really believing the Fed was going to do 50 basis points each meeting moving forward. Now, if we're going to get to 4.4 or 4.5, 4.25, somewhere in that range by the end of the year, what that means is that there's very likely a 75 basis point hike coming again in one of the meetings. As you might imagine, most likely probably the next one to come. But again, they are going to watch the data. So let's not get too far ahead of ourselves. But I think that's why the market is seeing what it is. Yesterday, it was every word. It seemed like the Fed had shared was a market moving event and kind of tapered off through the end of the day. And then today obviously opened up a little bit lower, not as terrible as it could be, but certainly a little lower here today too. So again, I think that's the biggest key. Again, this basically suggests another 125 basis points, 100 to 125 basis points by the end of the year with 2 meetings left. You can do the math. That means one probably 75, the other 50. But what I think was important is that they over and over again stated their ongoing concerns with inflation and that they are doing everything they can. They will continue to do everything they can to get their inflation target to 2%. We are a long ways from that. And so as you might imagine, that's where the aggressiveness comes from with the rate hikes. That's where the market pullback has come in the last day or two here. I think it's important, but what I want to touch on briefly is also that they had shared a little bit on reducing their balance sheet, which I think is actually maybe, I don't want to say more important, but certainly very important in this discussion. And I'm going to address that a bit more in our question of the week too. So again, reducing the balance sheet, interest rates, Fed funds rates raised by 75 basis points, plans for another 100 to 125 basis points by the end of the year. One of the things that I thought was really important that came out as well is that they had mentioned the idea of committing to get to a point where yields were positive across the yield curve, real yields. So in other words, interest rates are higher than inflation across 2s, 10s, 30-year bonds. Will that happen? I don't think it'll happen anytime soon. Obviously inflation running at, depending on which data point you're looking at, but maybe 8% or so. 2-year yield is at 4.25-ish, 4.2 today. We got a long ways to go to make up that gap. So number one, it shows the signs that the Fed is going to be very aggressive. But number two, it also shows that I think there's a lot ahead of us still before we get to that stage where the Fed is happy. The dot plot basically suggests most recently, this is kind of like the survey of the Fed members, that basically 100 to 125 basis points through the end of the year. 2023, some small increases, and then possible cuts actually in 2024 as well. So the question obviously is, well, what do we make of all this? I think the key, and we felt this way for a while, is that the Fed is going to continue to be aggressive. I think that the inflation number, what was that, last Tuesday, showed that this is a longer period issue. You know, it's funny to hear the Fed continue to talk about supply chain issues and Russia, Ukraine being the problem. Don't get me wrong, I think that does add fuel to the fire. But again, money supply is what I think is really driving this. And yet again, not a whole lot of talk about that. I'll mention that here in a little bit. But really, there wasn't a lot of conversation around money supply. Coming up, we've got consumer confidence, GDP revision, and initial jobless claims. But really, I want to spend a few minutes also on our question of the week because it is a great one. So thank you so much again, Amy, for sending this in. But the question of the week is the Fed prioritizing lower inflation or growing or keeping jobs, basically? And maybe to give a little context before I jump into the meat, the labor market, at least by the numbers, has been very, very strong leading up to this point. So if you look at the headlines, if you look at the data points out there as far as unemployment, as far as jobs added, all that good stuff, the labor market has been very strong. So I think that the Fed feels that they can be very aggressive with little impact to jobs, and they felt that way, I think, for a while. However, what I think came out of this meeting was a very clear sign of where their priorities lie. The Fed basically said they're going to create a lot of pain. They said they're going to raise rates. It's going to be painful. And they might as well have just said that the change in rates is going to lead to higher unemployment. They're going to lead to layoffs. Like they might as well have said that their policy is going to lead to job loss. Because at the end of the day, that's kind of what they're portraying. They said that they wanted to match up the supply and demand in the labor market, which obviously can be a good thing at the end of the day, but it does mean a lot of jobs lost potentially to come. And they've made it very clear they're not afraid of that. But with that comment, it is very, very clear that inflation is priority like 1, 2, and 3, right? I mean, it's very clear to us that is what they're trying to address. Not to say they don't care how many jobs are lost along the way, but they're willing to disrupt the labor market along the way to make sure that we tame this inflation beast that's kind of gotten out of control here. So this is just such a good question and very, very timely, especially with the Fed meeting yesterday and the comments that came out of that. But yeah, I mean, if you like, the Fed's going to be one of the big drivers in layoffs and in job losses and unemployment through the end of the year for sure. So, we'll see how this plays out. But I think especially after yesterday, it is very clear that the Fed's prioritizing inflation way above the unemployment rate. Okay, so with all this, the question comes up through the Fed, like, did they address the money supply? And as you probably got a glimpse from me sharing earlier, like they sort of did, but very indirectly, not very clearly stated. Finally, what they shared is that they're reducing or increasing their reduction of their balance sheet. What they've been doing in the past is almost nothing. What they're sharing now is that they plan to reduce their balance sheet by about $95 billion a month, which, to be honest, is still a bit of a drop in the bucket at the end of the day. But I think what's important is that, from what I understand, is they aren't selling these securities. They're actually letting them run off the balance sheet. And so that will help to reduce the money supply, right? Again, the Fed talks time and time again about supply chain issues, but never about money supply. They still didn't address it. But with what they're doing on reducing their balance sheet, the idea is that hopefully that will reduce that money supply, or at least the growth in money supply moving forward to some degree. Now, remember, their balance sheet is still $5 trillion. So $95 billion a month is not, it is a drop in the bucket, but hopefully that is at least a sign of heading in the right direction to help tame inflation a little bit moving forward. So we're going to keep a very close eye on that. It's going to take some time to carry through, but obviously the next inflation data point coming up in October is going to be really important, and then the Fed meeting to follow as well. So again, I want to thank you, Amy, again for that question of the week. I thought that was very, very timely, very, very helpful. And as always, if you guys have any questions for me, just let me know. You can drop it in the comments or shoot me a message, and I will be happy to answer those in our question of the week here moving forward. Have a great upcoming weekend. Enjoy, I guess, the first weekend of fall, and we'll see you next Thursday.